Okay, and action. All right, let's do currency. So when you're talking about stocks and oil and gold and bonds, you're going to be talking in prices. But when you start talking about currencies, you're talking about currency values. And you're going to be talking about currency values appreciating or depreciating due to aggregate supply and demand for dollars in the global marketplace, currency markets. The other is currency devaluation and revaluation. Currencies can be devalued and revalued by central bank or Treasury Department policy intervention. So you have appreciation, depreciation due to global market factors. You have devaluation, revaluation due to policy and market intervention through the Treasury Department and the federal central banks. So let's talk the economics of currency values. Let's start with the supply side. So you have positive supply shocks and negative supply shocks. Positive supply shocks would be that printing of dollars or a sell-off in the dollar market will increase the supply of dollars in the global currency markets, which will push down the supply curve. As the quantity moves out, prices will fall. When US dollar values depreciate, then the foreign currencies appreciate. So when the dollar depreciates, foreign currencies appreciate. And if you think that the dollar value against a trade-weighted basket of foreign currencies or foreign currencies, then that basket of foreign currencies and those foreign currencies are going to appreciate. If you think the value of the currencies are going to go down or depreciate, then you are going to write forwards, write futures, write calls on futures, buy puts on futures. You are also going to sell short, you are going to write calls, and you are going to buy puts on foreign currency dominated international corporations. You are going to, and individual multinational corporate stocks. If you think that the demand for dollars due to capital flight or other factors that we're going to talk about in a minute are going to shift the supply curve back because there's not enough dollars in the market, or actually dollars are being taken out of the market, it's going to shift the supply curve back, quantity is going to shrink, and the price is going to go up. If you think that the value of the US dollar is going to appreciate, then you are going to buy forwards, buy futures, buy calls on futures, and write puts on futures. If you think the dollar is going to appreciate, then you are going to buy on margin, buy calls, and write puts on US dollar denominated exchange traded funds and or multinational corporations and the multinational corporation stocks. On the demand side, if there is increased demand for US dollars because of capital flight or other factors, the demand curve is going to shift up and the prices are going to rise. If you are forecasting the value of the dollar to appreciate, then foreign currencies are going to depreciate. If the dollar is going to appreciate, you are going to buy forwards, buy futures, buy calls on futures, write puts on futures. You are going to buy on margin, you are going to buy calls and write puts on dollar denominated ETFs and dollar multinational stocks. If there is waning demand for dollars and higher demand for foreign currency, then the demand curve is going to shift back and the quantity is going to increase and the prices are going to fall, or the value of the currencies are going to fall, or the value of the currencies are going to depreciate. So if you're forecasting the value of the dollar to depreciate, then you are going to write forwards, write futures, write calls on futures, buy puts on futures. You are also going to sell short. You're going to write calls and buy puts on dollar-denominated corporate multinational stock ETFs and individual multinational corporate stocks. Lastly, let's talk about the demand side factors. What would cause demand for the US dollar to rise, thereby pushing up the dollar values and causing it to appreciate? One is just the overall amount of exports, not imports, but exports, or total volume of trade will impact the demand for the dollar. The other is just overall global gross domestic product, so overall production in the United States. So as production increases, the value or the return on investment assets will rise in comparison to other countries. So the demand for the dollar will increase as foreign investors see that dollar-denominated assets in the United States are appreciating faster than their domestic investments. So they will sell their foreign currency converted to US dollars, which would cause the dollar to appreciate, and invest those dollars in dollar-denominated investments because of the higher rate of return differentials between the two countries. Holding everything constant, there is an impact on the value of the dollar due to inflation rate differentials. So if the inflation rate is running higher in a foreign country compared to the US, the value of their currency is being eroded and falling rapidly, the purchasing power compared to the United States. So they will sell off their foreign currency, devaluing their foreign currency, or depreciating their foreign currency, and they will convert into US dollars, which will cause the dollar value to rise or appreciate compared to the foreign currency. So inflation rate differentials between countries have a major effect on demand for the currency if the inflation rate is lower in the target country. Again, holding everything constant and equal, interest rate differentials between two countries. If the United States is able to provide a higher interest rate or a higher rate of return on the treasury bonds compared to the foreign countries, then they will sell off their bonds. They will sell their foreign currency. They will convert to US dollars, causing the dollar to appreciate, and they will buy into the bonds because they're providing a higher rate of return than their foreign bonds. Also, holding everything constant, productivity differentials between countries, so really capital productivity, or productivity rates for labor. If the foreign country has low productivity labor rates compared to the US that has high productivity rates for labor, the investors will sell off or sell their assets in low productivity countries. They will sell their foreign currency. They will buy the US dollar, which would cause the US dollar value to appreciate in the global currency market. So productivity differentials. And then lastly is political stability or political instability. Political instability in other parts of the world has caused investors to sell off their foreign currency and convert into US dollars, causing the US dollar to appreciate significantly over the last year. The US is considered a politically and economically stable place to put money, so you have seen massive capital flight out of emerging markets and unstable markets and economies and move capital flight into the United States, into the US dollar, causing the US dollar to appreciate significantly against foreign currencies. The demand for the US dollar, since it's the reserve currency and most international transactions are transacted in US dollar, there's a certain level and consistent and persistent demand for the US dollar. Plus there's institutional reasons why the US dollar continues to be the dominant currency for international transactions and as a safe haven is because of the political economic regime in which we basically govern our politics and govern our economy. Most economies outside of the United States are either social welfare or socialist, democratic in most cases, but the democratic definition is different. Most of these are parliamentary systems, which are politically and theoretically politically more unstable because it's hard to form governing coalitions when you have a fractured government that's proportionally weighted by the interests that are reflected in the voting coalitions. So you have to build coalitions, then you have to have a governing party. A lot of times the coalitions break away and the governments need to be resolved and you have to have new elections. So there's more political instability and more elections in parliamentary systems. And some of those parliamentary systems also are either more socialist in their capitalistic systems or more social welfare, which really focuses more on social goods and social welfare. The United States is a representative democracy, a democratic capitalistic system. It's winner take all, majority rule. Even though we have current political instability in Congress, most of the politics is governed right of center. It's fairly stable politically, economically, which then increases demand for the US dollar, causing the dollar to appreciate, or at least a certain level of demand for the dollar to prop up its value and allow it to appreciate. I won't get into managed float systems, but we can talk about currency, or you might be interested in studying international economics or international finance at some point in time. That's the end of the lectures. Good luck. Please review these and then integrate what you've learned here today into your memos, and please upgrade the memos to business level quality as soon as possible. Thank you.